Welcome to an Alternate Hue. I'm Hugh Anderson, and this is some of what caught my attention recently. According to Jeremy Grantham, the founder of GMO, an institutional investment management firm, we're living through the most acute and broadly based asset bubble in modern times. Stocks, real estate, corporate credit, and cryptocurrencies, just to name a few. This is the first cycle ever, according to Grantham, where gambling has become a totally acceptable way to treat your finances and live your life. These are dangerous times indeed, but have been camouflaged by massive and repeated doses of policy stimulus, otherwise known as government largesse. So for the first time, the Fed's semi-annual financial stability report contained an entire section on how the financial markets have become infiltrated with neophyte investors during the cycle and the dangers that lie within from having the landscape filled with so many people who truly have no idea what they're doing. One factor contributing to this expansion has been the elimination of trading commissions at major brokerages for both stocks and stock options. Many years of growing revenues from payment for order flow helped set the stage for this development. Now, payment for order flow is the compensation that brokerage firms receive for directing orders to venues for trade execution. Retail investor trading flows can help market makers facilitate the execution of institutional trading flows, thereby promoting market liquidity, which is a good thing. But another aspect of this penetration by the inexperienced was the introduction of mobile trading apps. Now, many of these services are similar to popular apps from traditional brokerage firms, but these apps make investing more accessible in part by offering a wider range of products, including the opportunity to easily trade fractions of an equity share or crypto assets. Now, these apps also make trading more visually appealing. Many apps have color-coded graphical layouts that highlight stock movements, mark trading milestones, and have animations celebrating a user's stock purchases. With the ease of access and engaging graphics, such apps can make trading seem like, well, a game, particularly for younger or less experienced investors. Now, consistent with this style among trading apps, the average age of account holders is 30 years, and nearly half of them self-identify as first-time investors. The open media or social media platforms also shaped how some retail equity investors communicate about markets. Recent academic papers have shown that social media can increase the information flow to retail investors, which is good, as well as the amount of noise in markets from retail investor trading, which is bad. In addition, social media can contribute to an echo chamber, which retail investors find themselves communicating most frequently with others with similar interests and views, thereby reinforcing their views, even if those views are speculative or biased or flat out wrong. Now, more generally, social media platforms allow a single comment or post to reach millions of people and potentially affect market sentiment dramatically within a short period of time. Sounds a lot like the political alignment of social media. To date, the broad financial and stability implications has not been meaningful so far. The recent episodes of meme stock volatility did not leave a lasting imprint on the broader market. But a few things should be monitored. First, younger investors have a lot more debt, and so the slightest swing in asset prices, especially lower, could leave them financially vulnerable. This vulnerability is amplified as investors are now increasingly using options, which can often boost leverage and amplify losses. Second, episodes of heightened risk appetite may continue to evolve with the interaction between social media and retail investors and may be difficult to predict. A potentially destabilizing outcome could emerge if elevated risk appetite among retail investors were to retreat to more normal levels. And third, the risk management systems of the relevant financial institutions that have produced these apps may not be significant or substantial enough to withstand increased volatility from financial losses and could result from the trends highlighted here. So more frequent episodes of higher volatility may require further steps to ensure the resilience of the financial system. That sounds ominous, and quite frankly it is. One can only hope these newbies start doing a little more homework beyond their social media friends. So let's finish up with a recent initial public offering of yet another electric vehicle company. No, I can't mention their name or I'll be sent to my compliance officer's woodshed. But this wildly successful company is now worth $120.5 billion. It has sold 156 vehicles. What's not to love? But we live in the age of free money and endless government subsidy, which is the only way to explain this type of valuation. Investors are betting government support won't let it fail. This company is 12 years old and being hailed as the next big thing, yet almost all of the whopping 156 units they sold were to its own employees, and this quarter it's expected to have $1 million in revenue. That's revenue, not profit. Profit is the Loch Ness Monster of Wall Street for these companies these days. Much discussed but never seen among this crowd. Nonetheless, the company raised nearly $12 billion, and as euphoric investors rushed in, the company's value ran up to a wonderful $120 billion. Now, a certain other vehicle company that's been around for over 100 years, and many of us have bought their cars, recorded $122 billion in revenue last year and sold 6.8 million vehicles. Its market cap, $89 billion. Ponder that one. The newly public electric vehicle company also noted in its prospectus that it would be treated as an emerging growth company under the 2012 Jobs Act until it completed its IPO. So that means the $100 billion startup, in quotes, didn't have to comply with many Sarbanes-Oxley disclosure requirements or accounting standards. This didn't seem to trouble investors too much, not even after recent problems at other EV startups that have generated public investor euphoria. According to the Wall Street Journal, we're living in an extraordinary moment. We are watching the government literally underwrite a new industry before our eyes, steering capital to electric vehicle makers regardless of prospects. In post-capitalist America, you can still become a billionaire overnight if you're in a business favored by politicians. And I just have to ask, we're going to reduce the number of tailpipes floating around the world. That's great, I guess. But how many smokestacks are we going to have to add to make all that electricity? And what are we going to do with all those batteries as they wear out? I'm just asking for a friend. So that's it for now. Don't forget to look for more thoughts from Hightower Las Vegas on social media. I'm Hugh Anderson, and this has been an Alternate Hue.